Good afternoon, everybody. Welcome to the next in the Admirals Trading Spotlight webinar series. I'm Paul. Great to have you here. I hope you can all hear me. I hope you can all see me. If you're joining us here today in the on the live session, fantastic to have you here. By all means, put your questions in the chat box. If you're watching this later on the Admirals YouTube channel, once again, fantastic to be here. Okay, you'll be able to sort of put your any ideas or thoughts into the comments box underneath. Maybe you've got some questions, maybe you've got some ideas about how we can things we could cover in the future. You'd be very welcome to put them there. Also, if you're joining us here live today, it's just remember you'll get a little feedback form after the end of the session today. So we'd really appreciate if you just take a couple of moments just to give us that feedback. We will help it, and by all means, if you're watching this on YouTube, make sure to subscribe and give us a thumbs up if you found this content useful, or even a thumbs down. We don't mind. We appreciate all of the feedback. So today is our session. We're going to talk about basically, it's the third session, okay? What I've covered this week, every month, is about simple trading strategies, okay, for beginners to trade in 2022. So you might remember we did one in January, which was on what we call the fiery cross. Last month in February, we did a session on false breakouts. And today I'm going to share with you another very simple, almost mechanical trading setup that new traders can take away and utilize in their own trading. So without further ado, let's bring up the slides and crack on, ladies and gentlemen, shall we? So just bear with us a moment. Let's get all this working here. Okay. So once again, I hope you can basically hear me. I hope you can see the slides there. Great to have you there. Okay, Tina, fantastic. Darshan, Lord Wallace, that's very kind of you, Darshan. Not quite Lord, yes, but there's there's plenty of time. Hartmut, good afternoon. Zutas, great to have you here. Magdalena, that's fantastic. Great to have you here as well. And I hope I've pronounced your names correctly there. If I haven't, it's on me and such. So I apologise, but the sentiment was right. So as I said, today let's talk about trading tactics, okay, for beginners. So as I said, this is the third part. I think I might be doing another one next month, okay, just to add, just an additional tactic. But if you missed the first two, you will find them on the Admirals YouTube channel there, which is an absolutely it's a mine of fantastic content created by not only myself, but also my colleagues, Jens and Marcus. So be sure to check that out. I wonder if my wonderful assistant, Nastia, might put up a little link to the YouTube, Admiral YouTube channel. Be sure to go down and actually take a look and find it. But today is part 3. All right, I'm going to talk about a specific little setup that will help you join trends. Very simple, very mechanical. Which is what I like, because for a beginner trader, the setup is either there or it isn't. There's no ambiguity. There's no real kind of, need to sort of, use any kind of subjectivity apart from one element. So it gives you an opportunity to basically, sort of join a trend, which is what we're going to talk about today. Thank you, Nastia. She's put the link there. Okay, as always, fabulous. And remember, here we are, Admirals, Forex and CFD broker that is licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing the opportunity to engage with financial markets using both the MT4 and MT5 platforms. If you have any questions about Admirals, please get in touch with your account representative and they'll be very happy to help guide you. And, as I say, always, if you want a little bit more up to the moment, up to the sort of minute content, then I can recommend that you subscribe to Admiral's Telegram channel. As you can see there, the handle is @Admirals. So be sure to do that, and then you'll be able to sort of see the fabulous content that the Admirals team put out there. So be sure to add that to your watch list. So here's what we're going to talk about today. How we can rejoin an existing trend if we have missed the initial move. What is the FTR, the fail to return sit-up, and how do we use it in our trading to join an existing trend? Lots for us to talk about. And what we'll do is also, once we've gone through that, if there's time, we'll switch across to the live markets, because I always appreciate that it helps people to be able to sort of, learn the content, the education that we provide, but also just seeing how it's going on in a particular live context. For those of you who don't know me, my name's Paul. All right, many years ago, I was a battle manager, and you know, I've traded for a long time now for both hedge funds and clients. My sort of focus tends to be on trading FX indices and commodities, and for sort of longer term swing positions. Okay, I'm a trend trader, and for my intraday shorter term trading, I tend to be kind of reversal and mean reversion trader. So, as I said, here we go. Simple trading tactics for beginners in 2022. And you'll see that Nastia has put in a link to our Telegram channel, so you can quickly click on that and join there, okay, and be able to see that, all the great work that they do there. So, as the slide says, ladies and gentlemen, you know, in previous sessions, we looked at simple tactics like the fiery cross and also false breakouts as potential trade setups that beginners could effectively utilize in their in their trading journey. And what we're going to talk about today is really, it's impossible to capture the start of every new trend despite a trader's best wishes, and that doesn't matter whether you've been trading for 2 weeks or 2 decades. All right, sometimes when people are new to trading, they feel and think that they have to catch every start of every new trend, and I'm here to reassure you that that is not going to happen. Okay, despite your best wishes, and even someone with my experience, you're just not going to capture the start of every new trend. All right, you might wish to, but it just doesn't happen. All right, so you can relax. All right, you don't have to put yourself under the pressure to try and call the exact turning point and the exact start of new trends. But what can we do? How can we join that new trend in a very simple, clear, and easy way? Well, that's why you're here, and that's why we're going to talk about it today. And as the slide says, many traders are looking for a simple mechanical trade setup that will allow them to engage with financial markets. And today we'll discuss one simple setup that traders can take away and use in these situations. So I appreciate that we always have a kind of a wide range of experience of people joining us for our sessions, from complete beginners at one end of the spectrum to advanced traders who've been trading for a few years. Okay, so there will be something here for everybody, and what it'd be interesting to know is from the people here joining us today is what has been your experience of joining existing trends. Do you have a particular setup that you like to utilize to effectively get you into a trend, or is there a way that you've struggled? Okay, you've struggled to identify, just a simple way to get into a trend, and perhaps maybe you get a little bit overwhelmed, which is okay. As I said, I appreciate we have a broad spectrum of people joining us for our sessions, and it's really an opportunity here today for you to share your own experiences and also to learn just something very simple, okay, very mechanical in terms of ways to sort of operate and sort of join those particular markets. So let me just move myself here so we can see what we're talking about. Let's go right back to basics for new traders. All right, and let's think about how do markets move. All right, I'm going to sort of presume that even people who are very new to trading will have spent some time looking at trading charts, and it doesn't really matter whether it's the monthly chart of gold or the 5-minute chart of euro dollar or the 4-hour chart of Bitcoin. Doesn't actually really matter what particular instrument you look at, although for examples and work today we're going to focus on FX markets. But what I'm going to share with you is what I say is time frame and instrument agnostic, so it will work across whatever particular instruments you utilize and focus on, and what particular time frames you look to focus on as well. But what we do know is that we know that markets never move in a straight line, even in a strong trend. Okay, they never sort of move in a straight line. Okay, you can see here there's always a bit of a zigzag. Okay, even in the best trends. Right, and as it says there, even strong trends have pullbacks. Right, it's exceptionally rare that a market will take off and actually just continue to go. It just doesn't work like that. And the question is, for trend traders, can we use those pullbacks as an opportunity to join this new trend? And the answer, which most intermediate traders would know anyway, is that of course we can. Of course we can. Those pullbacks become very tradable opportunities in their own particular way. So, as I said, hopefully this is the kind of the baseline we can all work from. It's a baseline that we can all agree on, that namely markets never move in a straight line. Even strong trends, okay, will have pullbacks, and that those pullbacks are opportunities for us to join that new trend. I hope that makes sense to you. As I said, there's a kind of baseline from us all to work from. So, if we look at it in particular, we can talk about how, in a new bullish uptrend, we're going to get pullbacks. Why do we get pullbacks? Why doesn't it just move in a straight line? Why doesn't, when the market takes off in the trend, why doesn't it just basically fire off? Well, there's several reasons for that to happen. What you will find is that, as I say, excuse my drawing now. I always say, I'm a better trader than I am an artist, thankfully. Okay, but you can understand where I'm coming from there. Namely that when we look at, why in a bullish uptrend we get pullbacks like this, there is always somebody somewhere taking profit. Remember, you might be engaged in a new trend. You might be engaged, in trading that particular market. But you could be along with thousands, maybe even hundreds of thousands, maybe even millions of traders, okay, trading that particular trend. Everybody will have, different ideas, okay. Everyone will have, a different trade plan. Everybody will have, different outcomes that they're searching for. There is always somebody taking a profit, right? There's always somebody somewhere taking a profit. So if people have bought into the new trend down here at the start, well, what do they need to do to be able to take profit? Well, they need to sell. Okay, they need to sell. And if there's enough people taking a profit, well, then invariably we start to get a pullback. What we also do is, we also basically, we always have somebody waiting to get in. Because remember, when the sort of trend starts, there will be some, buyers here, but there will also be some sellers who've covered in their positions, okay, who are short and they realize they're wrong. But also there is also a huge swathe of traders who are sat on the sidelines, okay? They're sat on the sidelines waiting for price to pull back a little bit to give them a better price at which to enter what might be the start of a new trend. And also you can have just, market maker shenanigans as well, all right? Namely that, market makers are wanting to encourage more traders to join the new trend by cycling in and out of orders. So in order to sort of, to fulfill their own clients, so in order to basically keep the trend going, you might find that they will be doing buying and selling, okay? They will be jobbing around what might be a core position. So they can be doing that, and effectively, just basically cycling orders, okay, all the way here, just wanting to do to encourage, okay, to encourage all of those traders to get off the sidelines and join the trend. Remember, for things like, the dealers, the market makers, they only get paid when orders get triggered, right? Those little commissions, those spread parts of the spreads and stuff, that is how they get paid, okay? They only get paid when orders get triggered. So it's in their interest to sort of kind of get people placing orders. And if, if the prices are overextended, well, people will wait. People like me, pullback traders, sat on the sidelines waiting for the price to come back. They're basically, they'll do that. They'll encourage price down because they know that there will be plenty of buyers, at a bit of a lower price, because everybody loves a bargain. Why do you want to pay, top dollar when you could actually pay just to get a little bit of a cheaper price? Okay, that's that's trading, ladies and gentlemen. So that's what we see in a bullish uptrend. And not unsurprisingly, we see something very similar in a very strong bearish trend. Dalius is saying hello. You're very welcome, Dalius. Great to have you here with us today. And in a bearish downtrend, we also get pullbacks, right? We will get a pullback because, once again, okay, there is always somebody taking a profit. If you started selling here, okay, if you started selling right at the start because just for this occasion you were in the right place at the right time and your system gave you a sell signal, well, invariably once prices sort of carried on a fair way, there will be plenty of people wanting to cover and take profit, which means that if they've been a seller, they now have to buy the market to basically cover their positions, and so price pulls back. So, you know, when you are trading a trend, when you are seeing price move like that, you shouldn't really fear a pullback. In many ways, it's healthy within a trend, okay? It's healthy because invariably what it's doing is it's, you know, it's effectively, you know, getting the people who are not committed to the trend out and actually just getting that surge of people who've been sat on the sidelines, all right, who missed the start for whatever reason, who are basically looking to sell because they believe this is a new trend and they're looking to get on board. And as I said, you know, a little bit before, is that, you know, there will also be market makers wanting to encourage, okay, all those people sat on the sideline, right, they'll be wanting to encourage them to get off the sideline, to start selling, to place orders in the market. Because remember, they only get paid when orders get triggered. And to do that in order to effectively give the market the next shove in that kind of direction. Remember, we've talked a little bit about, certainly I have, about, you know, even with today's, you know, algo driven trading, we are still seeing that, you know, markets are still, you know, driven by humans. They are still a representation of human psychology. And with that, you know, humans, we surge, then we rest, then we surge again. And that's what a trend is like, okay? You know, we have a surge, we have a rest, we surge again, right? So, you know, that's just the way humans do. Humans can't operate at 100%, you know, 24/7 forever. We just can't, okay? You can try, you're going to get burnt out very, very quickly. You know, you surge, then you rest, and then you surge again, all right? And that's what markets are doing as well. And the pullback is the rest before the next surge, and being able to find ways to sort of, you know, to recognize that, to basically trade with that. Well, that can be a very useful way to join a trend, especially if you're, you know, if you're a beginner, if you're a new trader and you're still just trying to get a grip with understanding trends, understanding market dynamics. That's just what we're actually particularly looking for, and we're going to cover a great deal more of that in a few moments. So there we go. That is why, you know, that is why we're particularly seeing that. Okay, that, you know, into both bullish and bearish, that is why we're getting those particular pullbacks. So moving on, what we can talk about is, you know, most people will know and understand pullbacks. Maybe you prefer to trade breakouts rather than pullbacks. That's fair enough. You know, I've talked about that plenty of times. You tend to be either a breakout or a bounce trader. Personally, I prefer to trade little pullbacks. Okay, that's my personal experience and preference. There'll be other people who love to trade new breakouts, and that's absolutely fine. You know, it's about what works for you. Everybody has to find their own particular style. But, you know, as I said, most people will know and understand pullbacks. There are many, many ways to trade them, right? There are many ways to trade pullbacks. From, you know, we've talked about 3-bar reversals, we've talked about counter trend lines, okay, we've talked about, you know, pullbacks to moving averages, etc. You know, lots of different ways, breaks of structure or bounces off structure. We've talked about lots of different ways, all right? But what we're going to do today is I'm just going to share one very simple version, right? One very simple tactic, which is actually kind of ideal for new traders. And it's called the fail to return, or the FTR, all right? Many people, you know, might understand it. Many people, you know, might utilize it already. Many people may have learned it. But what I'm going to do today is I'm just going to give you a very, very simplistic version of it, all right? A very simplistic version. And what I did promise is, you know, I did promise as well is that I will do an advanced version of this, probably sometimes into the summer of this year, after a couple of months, so traders can actually have a chance to look and work out how to utilize it. But today, we're just going to talk about the simple version of it, right? Because it's about, you know, finding simple trading strategies for beginners, all right? So we're just going to do the very simple, basic version. And there are reasons for that, which I'll touch upon when we look at the actual trade setup itself. Dahlia says, glad to meet you. Yep, great to meet you too. Okay, absolutely fantastic. Great to have you all here. You know, as I often say, I appreciate that even though this is the English speaking webinar, Admirals have a truly global audience, and I appreciate we have people joining us from all over the world. You are, you know, you're very welcome. It's great to have you here. You know, we here at Admirals hope you're all safe and sound and having a good start to 2022. You know, regardless of the sort of shenanigans that might be going on in the world. You know, we hope you're all safe and well and ready to have a great trading year, because there's going to be lots of opportunity. So Let's talk a little bit more about the FTR, the fail to return as a tactic. So here it is as a simple setup, okay? And I like to put these things out as, very simple setups, all right? Simple, almost that you can just walk through and check through that, because that will allow you to effectively understand the setup easier, all right? Okay, and we'll talk a little bit more about it. So this is what's called a bullish fail to return, bullish FTR. The thing that to recognize is that the FTR is a momentum play, right? We're expecting momentum to continue in the existing trend, all right? So it requires the momentum of a relatively new trend. That is important, okay? You're more likely to be successful at the start of a new trend, where there are people ready to get on and get on board and actually drive the new trend, rather than at the very, very end of a trend. And we might be able to look at some examples of that on the live chart today. So what do we need? What's our first little point? Well, what we need to do, because this is a bullish fail to return, what we're expecting is price to basically make 2 or 3, okay, or more even bullish candles, all right, in an uptrend. So here we go. Let's, actually on this particular example here, which, is just a reflection of here, is actually we have quite a lot. You can see how all of them have got bullish closes. In this particular case, it is a very, very bullish, okay, a very bullish trend, which is strengthening. What happens then is we have what we're going to call a 2-candle play, right? A 2-candle play. The first candle play is price makes 1 bearish or seller bar. This is the fail to return candle. This is the pullback, okay? This is effectively, excuse me, like a 1-candle pullback, all right? Just a 1 candle, not 2, not 3, not more, 1, okay? It's 1. Right, and it's the next candle that confirms it, because what happens is, and this is the indication that it is a strong trend that we are looking to join, because what happens is buying then resumes, and the next candle is 1. It is a bullish candle that closes, and this is the important thing, it closes above the high of the previous bearish candle, and this is the confirmation candle, all right? So in many ways, what we've had is price goes up, it pulls back for 1 candle, and then the next candle goes up, and it ensures that it closes above the high. Think about what has happened there. In this particular case, we've had there's actually quite a lot of bullish candles, 1 single bearish candle, which is the FTR candle, and then the next candle, the confirmation candle, it's bullish, but equally, all right, equally, what it does is it closes above the high of that FTR candle, okay? Just think about that. It is effectively, there's a little pullback. It's that 1 candle pullback. The green candle, next bullish, it has to be bullish, has to close above the high. That is all, the price action is giving an indication that, this trend's got more to go. This trend is not over. This trend is basically, if anything, it's probably getting ready to accelerate. Remember, we've got a pullback here. Prices, in this case, prices pulled away, right? Prices pulled back. Why is it pulled back? You're saying, well, because there is always somebody, all right, who's taking profit for whatever reason. Their plan might be very different from yours. There's always somebody, the market makers are trying to, tease people off the sidelines. And there are also lots of people who didn't get in here, waiting for a pullback. That's enough of it. And they are ready and primed to basically to buy, to join the trend. And when the next candle starts, okay, and that's what happens, and it closes it, bang. That is your confirmation candle. It is your trigger, all right? And what you're looking to do is you're looking to buy at the market, okay? Bang, buy at the market, click the button. Your stop loss, because remember, we never trade without stop loss. Your stop loss is below the FTR bar, okay? It's below, in this case, the bearish seller bar. Your target, all right, your target should be at least 1.5 reward to risk, or the next level of resistance if you can see it up there, okay? Don't try and fight the market. Just utilize your good analysis. So there you go. That's a very simple, it's very simple bullish FTR. We need to see that, we are in a bullish trend. We've got 2, 3 or more, okay, bullish candles. Price then makes 1 bearish seller bar. This is the FTR candle. And then we need the confirmation candle. The next candle, bullish again. It closes bullish, and importantly, it closes above the high of the seller bar, the FTR bar. As soon as that happens, bang, we're long at market, stop beneath the low of the FTR, and then we're looking for basically around about 1.5 reward to risk. Okay, so that'll be the distance between you getting in and also where your stop loss is, and then just basically working that out and just putting in around about 1.5 reward to risk is what you could look for to begin with. Or just maybe the next resistance. Just don't be, don't ignore that. Okay, don't ignore if there is a particular, resistance or levels from your analysis there. So, how does that sit with you all? Does that make sense? Is it kind of simple? Is it kind of mechanical? Is it kind of, easy to see and to work with? All right, because that's what we're trying to do here. Certainly, in my kind of, here, these kind of new trading tactics is that, I want it to be mechanical. This trade either is there or it's not there. That's what we're after, right? It's either there or it's not there. And, for it to happen, it's very simple. 2 or 3 bullish candles, 1 bearish candle, followed by a bullish candle, which closes above the high of the bearish candle. If that happens, we have a trade. If it doesn't happen, we have no trade. It's mechanical. It's simple, right? Very often new traders trying to sort of, utilize very complex tactics and strategies. And what I suggest is a new trader, you just want a very simple one, just to basically get you into the market, allow you the opportunity to engage with markets and build your trading experience. So Rudolph says the low of the spike of the FTR bar is the stop loss. That's correct. Yeah, the low of the FTR, low of the pullback bar, okay, is the stop loss. And actually what you'd be looking to do is just, just make sure that it's just your stop is just a few pips beneath that, depending upon the time frame that you're particularly trading on. But I'd be saying that between like 2 to 5 pips beneath the low of the FTR bar, that is where your stop loss goes. Raquel says that this is very clear. Fantastic. Okay, that's what we hope for. Just nice, simple, straightforward tactics that you can take and utilize in your own trade. So that was the bullish. Let's have a look at a bearish one, right? And it's just kind of pretty much flipped, all right? It's just kind of flipped. So this is a bearish, all right? So we're looking to join a downtrend. Remember, as I keep saying, the FTR is a momentum play, so it requires the momentum of a new downtrend, okay? Remember, we're looking to preferably get in this at the kind of, as near to the start as the price action shows us, not necessarily at the end of a very long trend, okay? That's what our preference would be, all right? And so what we're looking for, price prints 2 or 3 or more bearish candles, so we need seller bars, okay, showing us here. So, in this particular case, here's the turnaround, right? Then bang, there's a second, there's a third, there's a fourth, okay? At least 2, but 3, 3, as Della Soul sang in the 1980s, 3 is the magic number. But, 2 is enough, okay, in good, strong trends. But then what we see is price makes 1 bullish buyer's bar, okay? A green bar. This, all right, is the fail to return candle. Price in this particular case, we can see the sort of, the arrow, having pushed in 1, 2, 3, 4 seller bars, it then, okay, prints basically a bullish candle. That is the FTR candle. So what we're doing is waiting for the next candle to see if that is the confirmation candle. What does it need to do to be the confirmation candle? Well, we see the next candle, the selling starts to resume, and the next candle, ends up being a bearish candle. It gets its close. Most importantly, it closes beneath the low of the previous FTR candle, right? That becomes the confirmation candle. And it needs to close beneath it. Doesn't matter if it closes, 1 pip, 5 pip, 10 pips, right? It probably, we'll look at a few examples where it probably closes too far. But the important thing is, even if it's like, even if it's just like a, a 100th of a pip, 10th of a pip, 100th of a pip, it closes beneath that low, okay, of the previous FTR candle, the bullish candle. That is enough. That is confirmation, okay? Remember what I'm saying. The reason I like this for new traders is it's quite mechanical, The trade is either there or it is not. You need 2 or 3, okay, bearish candles, followed by a bullish candle, followed by a bearish candle that closes beneath the low of the bullish FTR candle, right? If those things happen, we have a trade. If they don't happen, you just carry on, watch the market, okay? It's very, I think for new traders, simple tactics like this, are much better for them than complex, strategies, okay? We have, as humans, and I'm guilty of this as the next person, sometimes we overcomplicate things, right? We look at the markets and think it can't be that simple. I need to add, more indicators, and I need to add more stuff to my charts, all right? And actually, very often you don't. A simple plan executed flawlessly is the best plan you can have as let's say, as a manual trader. Trust me on that, okay? And as I said, but once you get, okay, the confirmation candle where it closed beneath the low of the previous bullish candle, okay, this candle here, that's your confirmation. It is also the trigger. Sell at market, okay? So you're selling at market here. Bang, you're selling at market. Your stop loss, let me clear this. You're selling at market here. Your stop loss, okay, goes above, all right, the high of the FTR bar. So, because we're selling into this, what I'll be saying is it's probably, 2 to 5 pips plus the spread, all right? When you're selling, you need to buy to cover. That's what I'll be suggesting, and that effectively is, our trade is on. And what we're looking to do is our target will be, kind of 1.5R, all right? 1.5 times our risk. And that's what we can do, okay? So a bit like the last one, we just looked at the bullish version. Look at the bearish version. Is that clear? Do you think you could utilize that in your own trading? Do you think that you could go away from today and write down these rules and start to make yourself a little checklist, a little trading plan that you could work with? As I said, it's a very simple, okay, simple mechanical setup. That's what we want for you. That's the way we look to work. So, I've got a few examples here. This, what I was talking about is, this is 4 hour, okay? This is a 4 hour example, but I particularly, because I trade a lot on the 4 hour useful, but also on intraday, you can basically have as a couple of, excuse me, as a couple of 4 hour or 30-minute charts, okay, for an intraday basis. I tend to work very well. This is a particular example here, all right, as in price had been in an uptrend. It then rolled over. We saw as we've actually got two sellers bars, which is very strong. Then what happens here? We get an FTR candle. The next candle basically comes down, and basically what does it do? Click. It's a seller bar, closes beneath it. You sell at market with your stop loss above the high of the FTR candle, and you can see the trade works its way. And actually, we go on a couple of candles. And what happens is, we've been in a seller candle, then we get, what do we get here? We get another bullish candle, okay? It's a pin bar, it's just a sliver. That's an FTR candle. And then what happens with the next candle? Bar, it basically, it's a seller candle which closes beneath the low, right? And then effectively, that is another trade setup. And actually what we can see is that, the trade actually continues down, right? It actually puts in an FTR here, which follows by a confirmation, and you have your stop above the high of the FTR candle, and it continues down. And actually what we see here is that you stop there until the price reverses. Remember what we were saying, what we want to do, there's lots of FTRs there, but it's actually, it's the first couple that we want to get on board. We want to get on board the kind of the sort of start of the trend rather than towards the end of the trend. So hopefully you can just see that. As I said, this is a 4 hour chart. The great thing about the 4 hour chart is, you can take your time. You can see as you're coming up to the 4 hour candle being complete, that you can get yourself ready to effectively to trade that, all right, to be ready for the setup. This boy is on the Kiwi dollar, okay, which we'll have a little look at in a moment as well. And invariably, let's get the old tool up here. Is what actually happens is, we see that basically, price is moving up here. And then, what we see is, we've got a couple of bullish candles. Then what do we get? Bearish candle, right? Which basically the next candle confirms and closes, and our stop is beneath there. Our target is, up here. And then actually what happens is it sets up again, okay, by which time, I'm happy that I'm into the trend. It basically, we have a pullback, which the next candle closes beneath, and then basically it moves on before it reverses, Okay, so, ideally, we want to get into good trends, all right, at the start of trends, but sometimes, sometimes you're getting in at the middle of the trend, all right? We want to be, middle of trends, okay, towards the end of it, not so much. That's not really particularly what we're, looking to aim at. More examples here. What we'll do is we'll switch to live markets in a moment, and this is just this is actually the FTSE on the 5-minute candle here chart. After the start of the Asian session, the session opens up, and then we basically, it effectively puts it in a kind of very scrappy double top. So I'm expecting a reversal anyway, and then we see, a couple of candles, price drops strongly, and what does it do here? Prints, an FTR candle there. Right, we get the one pullback, and it's confirmed by the next candle, which is a bearish candle, which closes beneath the low of the FTR candle. Traders on, our stop losses above the high of the FTR candle, and then we're looking to basically about 1.5, right, 1.5 reward to risk to begin with. Actually, trade carries on and does well, and actually sets up again, sets up an FTR candle with a confirmation candle there, right, and then basically once again you're into that trade until actually we see a reversal pattern here, okay, that tells you that particular trend is coming to an end. All right, so this works, as I said, it's across time frames, it's across all time frames and all instruments. But what I have found personally, kind of for new traders, maybe the 30-minute chart is quite a good one, and the 4-hour chart, because the 4-hour chart, it just updates a couple of times a day. You can do it around maybe your day job, or maybe your other kind of other work, okay, or other commitments, and you can see the candle sort of, you can get a little bit 10 minutes before the candle closes to understand and work out, yep, this is either the FTR candle setting up, or at the end of this, we're likely to get a confirmation candle, and I should be ready to take the trade. Just a couple more examples here. This is a euro dollar on the 4-hour chart. You can see that we've been into a trend. What happens is prices, lots of bearish candles followed by bang, one green bullish FTR candle. The confirmation candle closes beneath the low of the bullish candle, bang. Trade is on, excuse me, and stop above the high. And it actually goes on a couple more, puts in another candle, and then what we get? We get actually another candle that basically closes the confirmation candle. It's bearish, it just by a sliver, all right. It closes beneath the low of the bullish FTR candle. Remember, it has to close by a pip or two. It doesn't have to, close so much. Just even a pip. Just as long as it closes beneath the low, that is absolutely all that needs to happen, because it just shows that the momentum is returning, and we want to sort of surf that wave, so to speak. So here's a couple of final points before we switch to the live markets. Excuse me. This is a trend continuation momentum play. So there has to be momentum, right? If price is in a consolidation, if price is going sideways, give it a miss, all right? We want to see, the trend has started. For whatever reason, we haven't caught the right start of the trend, because that happens to everybody. Sometimes market will just move, and that's okay. But, what I suggest is to begin with, just look at it on the 30-minute candle and above. I know I showed a couple of examples of 5-minute because I want to show that it's across all time frames and all instruments. But to begin with, my suggestion is 30 minutes and above. Remember, the FTR candle is a single candle only, all right? It's not 2 or 3 pullback candles, it's one. It's one candle, and then the momentum comes back in. There's surge, rest, surge, and that's what we want to catch. What we do prefer is we prefer small candles to ensure a good reward to risk. So, you should be able to look at that just using your eyesight, but equally, if you don't, you could use the ATR. If you're just not sure if that, let's say if the confirmation candle is too big because actually the surge is too strong, right? If the confirmation candle is too big, then give it a miss. And we might have an example or two of that when we look at the live charts, right? And look at the setup in the context of the overall market picture. As I said, if market is consolidating, don't try and do that. What we want to do is basically to be able to sort of, as I said, there's a chance for us to sort of trade with the trend. That is what we are looking for. So in conclusion, ladies and gentlemen, it's impossible for both trend traders and reversal traders to catch every new trend. It's just not going to happen. We know that markets do not move in straight lines, right? They are always pullbacks in trends. This offers traders a chance to join the new trend. And one simple version of that is the FTR setup, the fail to return. Okay, it's failed to return because it's gone. It's gone. The FTR is a trend continuation momentum play, and it is a simple mechanical setup that allows us to join a new trend. And it can be used in both bullish and bearish markets and can be used across a wide range of instruments. So let's take a little bit of a look at live market, should we? But before we do that, if you've got questions or contacts, you can do so. You can go onto the Admiral Markets website. You can email at global@admiralmarkets, and they'll be happy to answer your particular questions. So as I said, just bear with me. And what we'll do is we've got a few minutes left. So what we'll do is we'll switch across to the charts and have a little look at what's been going on and see if there's anything that's been particularly setting up today for us. So just bear with us a moment. And, and we'll just switch across. So there we go. He says just, let's get rid of that. Let's bring up our, here we go. So, bang. I'm hoping that you can see the slides here. Sorry, rather than see me, and you can see the charts. This is the Admirals MT4 platform. Doesn't really matter which platform whether it's MT4, MT5, it's a price action setup, and so it's quite simple. So, this is a profile for the New Zealand dollar. Why? Because actually the New Zealand dollar has been moving quite nicely today because of the interest rate announcement earlier today and what was the Asia Pacific session. So let's have a quick look here. So this is top left. This is Kiwi dollar. All right. This is the New Zealand against the US dollar. And what we have here is, let's get the old chart. Let's get the old drawing tool. You can see that basically, price had been, price has been in a trend. This morning, what we had was, we had 1, 2, we had 3, bullish candles in an uptrend, followed by a very small FTR candle, followed by a big, strong confirmation candle. Now, normally, if it's a really huge candle, I would say that, you can give it a miss because your reward to risk will be skewed. But in this particular case, I'm happy with it. Okay, the candle is about normal size, all right, for the Kiwi dollar. And I also know that, we're in a strong trend. And so, of course, then you effectively, what are you doing? Remember, confirmation candle occurs. You're buying, buying at market. Your stop goes beneath the low of the FTR. And what we're looking for is about 1.5 to 1 reward to risk. And actually the price carried on, but, that is the simple trade to begin with. So that was very much a clear start. And that was on the 30-minute charts there. This morning, there was also a setup on the Kiwi dollar yen this morning. All right, let's just try and zoom in here. Okay, is that, kind of similar to the Kiwi dollar, namely that, we're in an uptrend. Okay, we're a strong trend simply because we knew that the markets, the news had been, very positive out of the Royal Bank of New Zealand. So, there was a bit of a surge going on. And what we saw is as the Asian session was coming to an end, we saw, 1, 2, 3 bullish candles, followed by, 1 bearish candle, the FTR candle. The next candle, the confirmation candle, is bullish again, and it closes above the high of the FTR candle. So bang, you buy at market, your stop goes beneath the FTR candle, and your target is around about 1.5 to 1 to begin with. Okay, simple trade. All right, bang. You're joining the trend. All right, a little bit of a pullback. Everyone's waiting to get on board. The train is there for you. Okay, the train is where you get on board, ladies and gentlemen. If you don't, then you'll have missed it. So there were a couple of examples on the 30-minute chart, but also the Euro New Zealand on the 4-hour chart. For those of you who will know what we saw, let's get into this. Here we go. Is actually, price had been in a bit of a consolidation, and then price was in a trend. Okay, and this week we started again, and what we can see is price. We can see that price was dropping, consolidating, pulling back, dropping, and then what we saw is basically we could see we had a couple of seller candles followed by 1 bullish candle. Okay, which was the FTR candle. The next candle was a confirmation candle, all right? So as soon as that happened and it closed beneath the low, all right, of the FTR candle, you sell. Your stop loss is above, right? Your stop loss is above the high of the FTR candle. Your target is 1.5 to 1. And then what happens is we get 1 seller candle, 2 seller candle, then we get another FTR candle, another bullish candle, and then basically price drops. And here's the thing here, this is a good example for us to end on, is just what we saw here is, we can see here, when this set up, we had, our entry was here and our stop was here. In this candle, we've already actually been moving for quite a few days, and you can see, yes, we have a lovely little small FTR candle, but basically, bang, we have effectively, the candle has moved a great deal already, hasn't it? It's actually moved a huge amount, bigger than the majority of the candles. And so actually, if we enter here, all right, and our stop loss is above, what that means is that, we need to go a considerable distance to be able to hit our target. So in that particular case, what we suggest is, when you get a really huge, big confirmation candle like that, is actually you give it a miss. Okay, and I appreciate that can be frustrating, but what we're looking to do is to find, a good size confirmation candle that allows us the opportunity to achieve our 1.5 reward to risk ratio trade. Right. Just clear that off. Mladen's asking what moving averages do I have. I just have a very simple blue 20, a simple red 50, and a simple green 200, which are helpful for identifying trends, but actually are of no real relevance to this particular setup. No particular, you don't need them on there for you to be able to do that. So there you go, ladies and gentlemen, another simple trading tactic for beginners to use in 2022, right? The FTR, the failed to return setup. Very simple, very mechanical, as I said, take it away, start to have a look at it on the charts that you trade at the moment. Maybe there's an instrument you particularly like, just go through, have a look. Does it set up? How does it play out? Okay. How often is it successful for you? Right. It's a simple trade. Okay. It's either there or it isn't. There's no ambiguity. And that's what I think is good for beginner traders. So as I said, remember there should be a feedback form that will come through to you straight after this session. If you'd be so kind to just take a couple of minutes to give us some thoughts and ideas, okay, and what you found useful about today's session. As always, I wish you the very best of success in your own trading, ladies and gentlemen, and I look forward to speaking to you soon. Trade well, everybody. Cheers.